Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. All right, so hello, everybody. We're live for the weekly web show. Excited to have a good friend of mine, Brian Yormak. He's at Story Ventures. So excited to have you, Brian. Good chatting with you. A couple minutes earlier to this, and we chatted, once or twice on the phone, and haven't gotten a chance to meet in person. But we're both in New York, just celebrated the 4th of July. So excited to get to know you better and share your story with the community and hopefully learn a lot from you.
Completely. Thanks for having me on.
Yeah. So why don't we just kick this off, jump right into it, and just talk a little more about your education, your background, your family. I know you currently got some family in Westchester. So is that kind of your upbringing where you grew up, or did you move to New York later? And just walk me through your early years. Getting into, the industry that maybe you started with and how you broke into VC, and then we'd love to dive a little deeper into what we're seeing in the markets and also just the origin story of Story.
Yeah, completely. All right, so I'll go all the way back. Grew up in Westchester, went to Horace Greeley High School, then went to University of Pennsylvania. As a little bit of additional context, started the fund with my brother. It's relevant because he also went to University of Pennsylvania. So my path, I went to Penn, then graduated, went into investment banking. Did not particularly enjoy it. Didn't think I was going to particularly enjoy it, but I did have kind of like a proclivity to finance. So did that for a bit. Ended up finding out about a fellowship program called Venture for America. It's similar to Teach for America, but for entrepreneurship. So going to emerging cities across the U.S. to support the entrepreneurial ecosystems. Did that, applied for and got a job at a venture capital firm called Fontinalis, started by Bill Ford, who's exec chairman of Ford Motor. So I was focused on the broader world of smart transportation. So things like autonomous vehicles, connected vehicles, robotics, that whole world. I'd say that was kind of my first break. Like most people don't get into venture soon after school because this was through a fellowship program and a Midwest firm. There was kind of like a differentiated path to get involved there. So I ended up doing that, had a great experience, incredible team there, and got really lucky in that I was at the intersection of kind of AVs, and I was tied to a automotive company in Ford. So I had a fairly good view into the commercialization of autonomy, right? What did Ford, Toyota, GM actually want to see in terms of technology to bring that into their ecosystem? While I was doing that, my brother, who is now my partner, went to Penn undergrad, then NYU Law, then went to practice law at Cravath, large corporate law firm, then moved over to Gunderson to get closer to the tech and venture ecosystem. A few years into my time at Fontinalis, Jake, my partner, and I started talking, and we decided we wanted to start a business. We actually didn't know what type of business we wanted to start at the time, just that we wanted to do something together. Ended up ideating about a bunch, and I think we both settled on the fact that one, I had an emerging thesis coming out of the autonomous vehicle world, which I can touch on, and two, at the time, Gunderson was by far the largest law firm in New York representing startups. And so Jake had access to deals and a network. I had kind of an emerging thesis, both geographical and technological. And so we started putting that pen to paper in terms of testing out that thesis. On the heels of that, raised our first fund, which we consider to be a proof of concept fund in 2016, $5 million. That's generally gone well. So then in 2018, we raised our second fund, $25 million, and that's generally gone well. So in 2021, we raised our third fund, $42 million. I can touch on the thesis and kind of how we got there, but that's the really quick origin story of how we started the firm itself.
No, happy to dive deeper. I was just curious. So what were some of the other business ideas that you and your brother had, and how did you kind of start hashing through those business ideas?
Well, the first thing we did, I don't know if you remember, you probably did FanDuel DraftKings came out with daily or weekly fantasy. So Jake and I raised a micro fund, like $20,000 from our friends, and started to deploy that capital into the weekly fantasy football leagues. We ended up doing really well. Quickly learned that was not scalable in any way, and so returned capital on that. But that was like our first foray into investing broadly.
Yeah.
Honestly, on the company side, part of the reason we did a fund was we didn't actually have a substantive product or services business that we wanted to go into. We knew that we wanted to be within technology because of our interest and where I had spent time, but we weren't technical, so we didn't necessarily know how to navigate building a technical product. We hadn't built a commercial organization, so we didn't know how to do that. So part of the thinking was, okay, if we can do this, we can get exposure to really strong entrepreneurs, understand business building. We had a perspective on why we could invest well, primarily people-centric. But part of the reason we did it was there wasn't like a clear business that we wanted to start. But this felt like a really good way to build a network and access within the venture and technical community.
Sure. And then what were some things that you learned, working for the Ford, I guess the Ford family's firm? So was it part of their family office and it was just kind of like a corporate VC, or was it kind of a spin out of, Ford Motors?
So they had a really clever structure because they didn't want to structure it as a corporate venture capital arm. So it had one of their primary LPs was tied to that ecosystem. And I won't say the name because they're fairly protective of it, but they were a standalone fund. So they did raise external capital from other groups. And so they had kind of like the BD support of folks at Ford, given the continuity and the involvement, but it was and is a true standalone firm. And I do think that structure has worked really well because they have insights and knowledge into the category, but they're not captive to a specific company that allows for kind of like controls. So that's how they operate.
Got it. And, climate's been a really hot sector, especially mobility. So we actually held a climate, family office summit literally last week. Wow. The days fly by. One day feels like it's a week, but yeah, so, I've learned a lot in climate and happy to share what I've learned, but trends have definitely changed, especially in mobility. I'm seeing a lot of things in my feed with Elon Musk. Like he was talking just recently, he was talking about launching a van. And the reason why a van is interesting is because there's more surface area. So that's when it starts getting interesting. He was saying, like, if there's an apocalypse, that van could still get you around based on just charging from the surface area. And then there's also like a canopy concept that they created too. So if you want to tailgate, you can open up the canopy, and the roof of the canopy also provides some more surface area. So it's dual use. So, there's a lot of, interesting trends that are coming about in just mobility, and that's tied to climate. But what were some of the things that you saw that was interesting working for the fund for Henry Ford, and then now how have things changed, and how would you unpack that as far as just climate?
So I think it's a good segue into our thesis and what we focus on, because it will get at kind of how I think about these categories. So if you take an autonomous vehicle, to me, there were kind of three core technological thematics emerging from the AV world. One was improvements in sensory technology. So you can think about camera, radar, LiDAR, all these sensors getting way better in quality and way lower in cost. And the general concept there is you can digitize data from the real world in a way that wasn't possible prior. Two was improvements in compute. So you went from movement from on-prem compute to cloud compute, improvement in microprocessors, and movement of microprocessors to edge devices, which means that you can store, process, and organize data in a way that you couldn't prior. And then three was improvements at the AI or the algorithmic layer. So ability to derive insights from kind of big data as broadly defined. And so if you look at every AV stack, it's that, which is better sensory systems, better compute layer, and better algorithms or applications that sit on top of that data. And what we felt then and what we feel now is that data stack should comprise every sector in some capacity, right? So it should be built on data first systems with high levels of orchestration of that data, and then AI driven or dynamic applications that sit on top of it. And so our focus as a firm is on that data stack across sectors. Within mobility, even within climate, I think the way we view this is the progressions are a result of changing technical or regulatory occurrences, right? And so people talk about climate tech 1.0, people talk about crypto, and a lot of these categories there's a necessary need to invest into those categories, even if they were going to fail, because it pushes the bar of what is possible technically, and it pushes regulators to say, hey, we want this to exist in one way or another. And so I think a lot of the reason we see kind of a failed first iteration, but then a successful second iteration, is because you have kind of a commercial lens applied to the changes in technology for that category, right? And so if you take climate, for example, there are the R&D centric things like carbon sequestration. I don't really have an opinion on it, right? Like there's a sciences component to it. But if you think about EVs, for example, TBD on the speed with which it scales, but there is clearly investment, technical change that's occurring, which is connectivity of systems, better battery technology, plus regulation that is supporting the ecosystem to say, hey, we're going to subsidize dollars to scale this category. And those things needed to converge to enable the start of scaling EVs. Again, we'll see what breakpoints we hit, but we are in kind of a second iteration within that market where we're starting to see scalability, which is a really nice progression.
Got it. And, so that's really interesting insights in terms of just the mobility sector and just how the governments are really even partnering with the technology companies. So when you look at the data stack, what are some of the criteria that you're looking at as you're analyzing companies, especially in the early stage? They could be very capital intensive. So what are, some of the common threads that you've been seeing when you're picking winners in the early stage, especially in this space?
Yeah, I think for the companies we invest in, you have to start with a why now around data, right? Like there has to be an insight that enables you to do something today that could not be done prior, right? So take an example. If you look at healthcare, for example, there's electronic health records, right? Which is where your data is stored when you go to a hospital or to a healthcare system. Historically, that data has been inaccessible. There was something called the 2020 Cures Act, which basically mandated that if a patient requests access to their data, then the EHR systems have to provide that data to the patient. Now, the problem was there wasn't an interoperability layer, right? So there wasn't a way to pull data from Epic, Cerner, Allscripts, et cetera. And so we invested in a company called Particle Health, which is an API for electronic health record data. Now, there's the technical insight, which is the data has to be structured in a way that you can use it, but that was actually fairly feasible for the past, 5 to 7 years. But then there was the regulatory insight, which is that the government was forcing this thing to occur. And so we invested in Particle Health, I believe, in 2018, as these regulations were being formalized, and they now sit at that interoperability layer. And you can think about the progression of healthcare, which is, okay, you have all this electronic health record data that is now accessible. So if you think about proactive or prescriptive healthcare applications, so we invested in a company called Lives, Livez, and they provide proactive guidance as to what you should do as a prospective patient or a consumer, right? So what that means is, okay, Joel is a 35-year-old male with family history of heart disease and diabetes. There are certain things that Joel should be doing proactively to avoid the likelihood of chronic or acute disease. And so they pull in all that information to then inform you as to what you should do, right? And so if we think about the future of healthcare, it is this data-driven layer where it's, okay, the data is being collected, but now companies can use that interoperable and dynamic data to inform care. And so that's directionally where we should go.
Have you been following Brian Johnson?
Yeah, super interesting. Yeah.
So, that's, I don't know how old he is, but
he's ageless.
He doesn't look 18. But I shared this the other day because somebody kind of did a nice little write-up, but his goal is to be, I think, through his telomeres, like biologically the age of 19. So he monitors, I think, don't quote me, like 50 to 60 different organs. And he gets kind of that real-time data. And he takes a lot of pills and supplements as well. Yeah. But I think that's really interesting because, there's things that I think about with my family history of, health and I'm pretty much, doomed to kind of get that same fate unless there's something that I do more proactive. So I think it's really interesting. And, traditionally, and also probably politically, the hospitals don't have a vested interest to share all that data to the patients. Number one, because they could transfer care. But then the other piece is if there's some software that, can kind of tell them how to manage their lifestyle and tell them what, treatments to get without the hospital and possibly go solve their problems on their own through another mechanism, or just maybe through something over the counter, then you kind of completely bypass the hospital.
Yeah.
So I guess how has that been, with kind of, I guess, the 2020 CARES Act? So what you're saying is like the 2020 CARES Act, when they ask for their data, it's probably in just like a really messy PDF or CSV file. I guess how are they getting it?
Yeah. So there's now a standard called FHIR. It's Fast Healthcare Interoperability something.
Yeah.
So there's a standard that's coming down across the industry, which is the EHR systems are required to comply with that standard so that there's better data portability. Right now, because it's in an electronic health record, you do have kind of like export CSVs, but they do have some, I don't know if it's like ETL or what, but they have some mechanism to transfer the data.
Yeah.
But it is more complicated in scope. The other thing is right now, the data can only be requested for clinical care. So I want the data to provide to my OB-GYN. That's one thing, but I can't request it to be provided to my life insurance company, for example, because it's not a clinical use case. That is the next progression of what's going to occur, but there's a lot changing in terms of like how the data can be used. And to your point, what's probably most important is the incentive structures are still super wonky within healthcare, right?
Yeah.
So historically, what the patient wants, what the provider wants, what the healthcare system wants, what the payers want are often misaligned. And so what's happening right now is the government is putting a good amount of work behind trying to realign those incentive structures.
Yeah.
And people talk about value-based care as a concept, right? So generally what Medicare or Medicaid are trying to incentivize are reward systems, so basically pools of capital that motivate the providers to get to the best outcome, where the providers can then earn into those pools of capital. And so we invested in a company called Delphina. It's a platform meant to decrease NICU visits. So for pregnant women, there's X rate of pregnancies that result in a baby going to a NICU visit. Now there are things that you can do proactively, which is measure the heart rate of the baby, so fetal heart rate monitor, measure the weight of a mother because prediabetes is more likely to contribute to NICU visits, things like that. So they basically build a software platform that enables OB-GYNs to track this data over time. Now, the reason they've been able to commercialize is because they've gotten value-based care contracts where the payers basically will pay a premium for Delphina to work alongside OB-GYNs. And the reason they're doing that is because mostly there's subsidized funding from the government and otherwise that says, hey, this is a problem for us. We want to decrease NICU visits. And so even though you hospital will make less, we will figure out how to catch you up to drive a different outcome. And so the incentives in the industry are definitely changing quickly, which is super interesting to track.
Yeah, when I was doing grad school, I had a mentor. This guy was like an MD, PhD, and I think also FACS. I forgot what FACS stands for, but he was a retired surgeon from the Army, and then ended up working for DARPA. And he would just talk about stuff that was so futuristic, and he was one of my really, really big mentors that I looked up to. But he just said some stuff that was like next level, and like some of that actually came true in the last maybe decade. But essentially, one of the things he said is, hey, you could take a pill, and then in the pill there's like micro machines that can go in and do work. Another thing that I think would be really game changing is going to a center where you do a full body scan, and then the body scan, it can see your tissue, it can see your bone structure, and then you just do a blood test. And from those two data points, there's a lot of things that you can synthesize. And I don't think to this day there's that. I don't know if you've ever been to that place, Forward, but Forward was kind of trying to do this where you go in and you get a scan, and it's kind of like the doctor of the future. I don't know where that went, and I don't know how much traction they got, but I think that's an interesting concept where you can kind of just change a few things in your lifestyle to have better outcomes in the future. Just kind of reducing a couple fried foods a week, or just kind of getting real-time updates and saying, look, like your baseline compared to other people of your ethnic background and your origin, your baseline is actually lower than the average, and here's things that you can do. I think even for myself as a consumer, I think that would be a really powerful product. And I don't know if you've seen anything like that. That's kind of like B2B plus B2C, where, there's an end user that would probably pay a subscription, but then some of that data could be used for insurance companies. And is that something you're excited about? And do you think that's something that you're starting to see to kind of help people get, better Netflix style recommendations to improve their health?
Yeah, well, so as you're talking, there was one company that announced like a $50 million fundraise today. It was one of the Shopify founders. I can't find the name, but it is like it's a more modern version of Forward, which is it's like this full body scan.
Yeah.
And I think directionally that's super interesting. If you check out Lives, LIVZ, the company I mentioned earlier, so their whole product is building mobile scanning functionality, right?
Oh, wow.
So they can do things like
Yeah.
you take a picture of a mole and they're able to recognize the risk assessment. You can do an eye exam. You can do depression, anxiety tests, et cetera. But the really interesting thing about mobile in my mind is that it's far more accessible, right? So like everybody can do it at the endpoints. And that to me is super interesting because it's super low cost, super scalable, and allows you to capture a lot of that data at the endpoint that then allows you to navigate the system, right? Because historically, everything has been reactive by nature. So if we can create frictionless processes that enable people to capture data on themselves in some type of continuous way, in via mobile or whatever it is, that to me is kind of like the first step, saying, okay, like I have this information that I can track in advance of how I'm supposed to navigate the healthcare system. The one caveat, my father's an orthopedic surgeon, is there is this concept of kind of like overdiagnosis, right? And so like one of the interesting things we'll have to deal with is how do we think about overdiagnosing, right? Which is to say, okay, this is a potential risk. Does that mean you take action? Does it mean you don't take action? So I definitely think we're going to start entering into this world of overdiagnosis. And then it's just a question of how to navigate that, right? But I do think it's directionally right, which is let's get data on ourselves in a more continuous manner. And I think that will drive really helpful insights into our health.
Yeah. And I mean, it's, doesn't need to be like real-time data like the stock market if you're doing day trading, but I think, getting some type of insight about your body, and then I think some education along with it. Because right now, I mean, we use WebMD. If we've got a weird mole, we Google it, and we're paranoid thinking that, it's cancer. So I think if it's more personalized, tied to your body, and then there's historical genetic data that can plug into that over time, there's a lot of really cool insights. But then also just servicing that with some education and some knowledge about, your body, just recommendations on things to have a better, wellness protocol for your life. I think all of those things kind of packaged together. It's all the way of packaging too, right? So if you're getting it kind of in a really cool experience and it's not spammy, that probably improves drop off as well, because you're kind of getting it in a thoughtful way. So I think that could be pretty interesting.
And I think people are getting more data driven, which is good, right? Like it's it's a more objective scoring measure system. And I think the companies that are very focused on kind of like data driven approaches to, hey, here I can actually help you to quantify and understand yourself. I think those will be very powerful tools.
Yeah, I mean, I think it's very similar to financial wellness. Early on, probably post recession, people didn't really want to talk about finances, and it was really, I think a lot of millennials specifically, lived through the recession, right? I mean, so I think a lot of those people are much more thoughtful about their financial wellness in terms of saving and managing a budget. And I feel I've been seeing some content recently from people that are in their 40s, thinking about their health more because they want to think about, their families and being around. So I think there's a similar kind of movement now to kind of, be mindful of your health. I know I am too. I used to kind of just never sleep, and I'm consciously trying to get more sleep in and trying to just be a little more healthy in general. And that kind of ties to just, I think if you take care of your body, you're also taking care of your business as well, right? Because I mean, if you're not healthy, that's definitely going to slow you down. So I think kind of being more quantitative and getting more data can help guide you in the right way. And I'd say people that are also in their late 40s to early 50s probably are starting to see their parents go through some health challenges as well. So that's also kind of a wake up sign. So I think that also enables people to kind of use some more platforms for themselves as well, let alone their parents. So that's just kind of things that I've been seeing. So, and then what are some other sectors that you're excited about? So we got mobility, we got kind of just the whole data stack, and then what are some other industries that you're kind of just also looking at that's kind of within the range of your thesis?
Yeah, we're definitely spending a lot of time in healthcare, so that's one. I would say
Yeah.
the other is it's more horizontal, but it kind of falls into like the baby boomer business selling period, right? Where there's gonna be a lot of turnover, but we view it a little differently. Generally, the way we feel about AI defined broadly is that it is very good. It is very good at automating tasks, right? And a lot of the AI systems historically have been good at automating or supplementing blue collar tasks. A lot of the new AI coming out is going to be good at supplementing or automating white collar tasks.
Yeah.
And so we're looking for businesses where historically they've looked like services or operationally complex businesses where you can build them in a similar way, but far more efficiently, right? So an example would be we invested in a company called True Footage. It's a full stack appraisal firm. So what they do is they historically for an appraisal, you have to send an appraiser on site. They take measurements of the home. They then go back to their desk. They input the information, and that's how it's done today. With the smartphone, you can actually take a 3D scan of that in-home environment without having to have a professional that understands how to do that properly do it, right? So they can send a homeowner, a gig economy worker, a trainee on site, take a scan of that environment. It auto pulls the data from that environment and then sends it to the appraiser who never had to leave their desk, right? They can now do a desktop appraisal because all that data has been digitized. And so it enables you to do far faster turn times, plus operate on far better quality of data. And so if you take the appraisal market, the lenders who often are the ones that issue the appraisals, what they care about is the speed of the appraisal and the accuracy of the appraisal. So if you're able to improve that workflow via technology and automation, then you can build a really world-class appraisal firm. So True Footage has gone from $0 in revenue to tens of millions. I won't say the exact number, but over like an 18 to 24 month period. And it's because they just deliver a far better product than the incumbents because they've integrated a lot of technology into the process.
Yeah.
And so if you think about insurance claims where you have somebody going on site or different forms of complicated manufacturing, automation and AI can do a lot to supplement and improve that process. And so we're looking for those businesses where you can see how computer vision and natural language processing will meaningfully change how that business operates in the future. And then you're looking for kind of this combination of commercial and technological founders that can both build the product and sell into that market. And so a lot of our portfolio falls into that universe where it's businesses that traditionally weren't venture-like because they weren't as scalable and they were more operationally complex, but start to look like venture scalable businesses because of the changes in technology.
Sure. That's really helpful. And I like that transition from the blue collar to the white collar. What was some traditional blue collar industries that you specifically thought were good examples?
Yeah, I mean, I would say like manufacturing broadly, right?
Yeah.
So if you look at like if you go to an auto plant, right, like it's almost entirely automated. Now, historical automation has been more rigid by nature, right? So it's very process centric because there's not much variance. What happened with modern robotics is that they became kind of smart robots, right? So if you go to like a warehousing environment today, or if you think about Amazon bought. They bought a robotics company a while back. It'll come to me. But the concept was, okay, you have now dynamic robots that can leverage computer vision and or different sensory systems to do more dynamic things within the warehousing environment. And so you have pick and place robots, you have movement robots, you have robots that move trucks from one place to another. So I'd say like within that universe, you're seeing a lot of, again, supplementation and automation of more dynamic tasks, and that will continue in the blue collar universe. There's still a lot of things that humans are needed for, but especially like if you think about heavy lifting, for example, it's bad for people, right? Like it's bad for people's backs to constantly be lifting really heavy metal. They're probably better off supporting a robot that is picking up a pound of cement, right? Like so that you don't have to have 8 people doing that process. So a lot of the things humans probably aren't meant to do. Or where they can be used better. A lot of that will be automated due to kind of like mechanical strength of robots plus more dynamic systems.
So one white, I guess it's maybe white collar or blue collar, but like remote sales. So I feel it would be game changing because I think most businesses, depending on if it's B2B or B2C, they struggle with either, lead generation, qualifying the leads, or closing,
Yeah.
especially if it's B2B. So, leads can get optimized through better ads, through, just testing different ads. Qualifying ads could be done by just different funnels and filters and just maybe people qualifying them. And then closing, it's really a skill, I believe. And, you've launched a couple of businesses. You've actually also been through, launching a fund. So you could probably have some tips on this too, but you know, I feel a good salesperson can sell no matter what,
Yeah.
and they can learn the industry, they can figure it out, but that's kind of a magical skill that you have, and it's not really something that it can be trained. I think if you can think about like objection handling,
Mm-hmm.
but I think some people have it and some people don't.
Yeah.
And I think if there's a way that there's a huge data lake of all these questions and all these answers, closing essentially is kind of handling objections. And if there's a way to kind of really handle those objections effectively to kind of move them down to the closing path, I think over time that could be automated.
Yeah.
If there's a lot of history of a lot of calls, maybe the calls that didn't work out, there's insights that you can take from that. And then I think if you can kind of address the same questions in the same way, I think there could be AI that could be a scalable remote closing team. But I don't know what your thoughts are on that.
Yeah, I have a lot of thoughts on it. So I'd say first, there's like the process of it, which is collecting the data. So that's happening today, right? Like you have systems like Gusto, you have audio calls that are being done. Like there are a bunch of companies going after the data collection part of this, which is we need that data asset, right? And so I think that over the next 24 to 48 months will exist at enough scale that you could actually turn on a model to say, hey, like pull our data from our recorded calls plus our tickets, et cetera. And you'll actually have a pretty good asset that informs the ability to close and or what's working. So I think directionally we'll go there, which will be a really good resource for sales and product folks. I generally view closing, I bifurcate it into closing for growth and closing for sustainability, right? So like there is a point at which you have product market fit and it's just a reps thing, right? Like you're gonna close 30% of the folks that you talk to and just kind of doing the same thing over and over again. I think that can be largely automated. I still think you'll want a person there, but it is like, it's consistent enough in terms of the problems that are surfaced, plus like what folks are looking for. And you can think about selling like Monday versus Asana, right? Like there's a playbook that's there and like you know what needs to be said to do that well. I think selling for growth is far more difficult because it's more creative by nature, right? Which is I'm selling a new potential feature, or I'm selling a vision of what this is going to become, or I'm selling something you haven't heard of before. And I think those things, it's a little bit more dynamic, right? Which I need to see in that conversation what you're reacting to and why you're reacting. So I think that you're going to still have top growth salespeople that will be selling for something new, but I can see like selling what is current and what we know is validated to become more automated over time.
Yeah. What about fundraising? So, whether you're a founder trying to raise money from VCs, and then, so we've seen some of these articles, right, from some of these emerging managers. I mean, I think it was Elizabeth Yin and also Mac, the VC. They're like, look, we raised our first 15 million and, we took about 1,100 meetings, and they're actually, and they posted like their Google Doc of like all the LPs that they met. And they realized that just there was not really any correlation with who signed up and who didn't. It was really a volume game.
Yeah.
So do you feel there could be an AI investor relations agent?
I believe that AI will be very good at operational functions, but not closing functions, right? So like we have somebody that's helping us with lead gen, right? As in like to just go find people. And now like there's more data coming online, which is what funds have we invested in prior? What is the maturity of our current fund? And now the LP universe is far more opaque than most, but there still is data coming online. And so I do think there's a system that can find and aggregate the information so that then I or somebody from the team can go and reach out. In terms of closing, this is selling a venture fund, I think, is one of the hardest products to sell because you're inherently selling a black box, right? Which is you're betting on something that we've done before that provides signal, but something entirely new in terms of what the fund is going to look like. And yes, we might have a structural advantage or a track record, but you're not betting on a company where that asset is clearly something you're betting on and where the dollars go is very clear. And a lot of LPs view venture to be a commoditized category, which we strongly disagree with, but people do view it that way. What that means is it functions more like an enterprise sale, which is a very relationship-centric, heavy sale, and that has to be done person to person, right? Like I think it still honestly has to be done in person to in person for a lot of the time. But the heavier sales are definitely more relationship centric, and I don't see that going anywhere anytime soon because you're really betting on the person, and like you're not betting on a technology.
I feel the same way too. I mean, I've backed a few funds, and the reason why is just because I like that person, and I met that person at a party or something, or I got introduced to them. So, and I think one thing that was pretty profound is something that you can't even replicate on Zoom is observing maybe how you treat the waiter, right? Like, so if you're in a physical setting, just kind of seeing their gestures and maybe seeing how they treat somebody else or react to some statement, that's kind of hard to do in like a gated, digital box. So I think that's also something that you can get from meeting in person. And there's been some people that I've met at some of these like LP events that I've actually built like multi-year friendships with. And it's just because we remember that one event where we bonded or had something in common. So I think just in person in general is really powerful. Let's go deeper. Let's go a little deeper on thinking about the fund, thinking about portfolio construction, and also getting your first LPs in. So how, and you don't have to share your secret sauce or proprietary information, but how would you recommend people to think about their minimum viable fund, and then also like how can they build an engaged LP community to kind of do that outreach, right? I mean, most people would think, hey, let me just pay 22 grand for PitchBook and email blast everybody, but we know that's not going to work. So how would you kind of advise maybe emerging managers to think about that?
Yeah, it's a great question. I think about it way too much. So the thing that I've concluded is the only way to be a really good fundraiser. Well, there's probably two ways. One is just like momentum and FOMO and hype, which some people are good at. But if you're good at that or not. So if you're not, then I'm kind of speaking to those folks. You need to have a structural advantage, right? And so by that, I mean, you need to have a narrative that allows you to generate alpha within your category, or at least comfortably sell that you can generate alpha in your category. So venture, people hold up, you should have a 20% IRR, right? So now the question is, why are you going to have that or better? And what is your edge in the market that allows you to do that? I would say the biggest lesson I have from starting the fund is that I wasn't aware of that point, right? And so I was just trying to sell myself, my hustle, my intellect as our edge. Now, the reality is when we started, I was young enough that I didn't have anything else. And so that worked well enough. But when I think about it today, I want to be selling more than just Jake, myself, and the Story team. I want to be selling some type of asset that allows investors to understand we know or have something that other folks do not have. Right. And so when I think about that for us, I think there's probably a few things. One is we've been focused on data infrastructure and AI companies for the past 7 years since we started the fund. We're based in New York. And so most funds that have been doing that have been based on the West Coast historically. So we are one of a handful of funds that focus on what we do in the New York ecosystem. There was an emergent talent ecosystem forming when we started the fund. And so you have people that came out of industry, finance, consulting, et cetera, that understood the impacts of technology that started to build companies in the category. And so we built up a really strong network within the New York ecosystem in particular around a certain subset of types of companies that gives us a real edge. And then I would say the other, which is more a question, but I view to be a real edge, is we're hyper concentrated, right? So we invest in about 12 companies per fund. We're very focused on ownership, and we work incredibly closely with those companies. The primary reason for that is we believe that asymmetric information gives us an advantage. And so what I mean by that is if we are concentrated, Jake and I, as the two partners, can work incredibly closely with those companies to pick up the relevant signals to say, hey, we think this company can be an outlier, or we think this company cannot be an outlier. And so a lot of our job function is to spend enough time with these companies to come to an informed decision as to which one can be the outliers. And if we are right, because we are concentrated, we own more on a relative basis than other folks of our fund size, which means that we should be able to drive better returns. And taking that one step forward, if you believe in kind of like the power law dynamic of venture, all that matters is the upside. So we need to be right. And if we are right, we need to lean into that winner to maximize ownership and upside of the portfolio. And so everything we do is to, one, make sure that we are underwriting to outliers that can benefit from the power law. And then two, make sure that we are spending enough time with the portfolio to continue to test our assumptions as to which companies can be outliers, to continue to expose capital to those companies. And so that's how I think about kind of like the structural advantage, which is concentrated, data-driven in terms of the data we're collecting, plus a network of founders and others that give us access to deals that other folks wouldn't see. And that took 5+ years to build.
Yeah, no, that's helpful. I want to do a little mental exercise with you, which I think could help. And I just like to nerd out on this. So I had an LP on maybe a month ago, and we actually kind of like did a mental model of like 3 different funds. And, you know, the reason why I wanted to talk about that is because I've seen a lot of funds, you know, through our fund accelerator actually reduce their AUM size. So that really throws off their portfolio concentration. It also throws off their construction. And I would say even their just overall general strategy. So I'd love to kind of, you know, talk about like portfolio construction. So if you're doing 12 companies hypothetically, or you said 12 or 17?
12 to 15. But most have been 12.
So, and that also depends on the fund size. So if you're doing technically, so 12 would be for like a 15, like a, what size fund?
So fund 3 is 42 million. So we can go off of that one.
Yeah. So you're probably doing at least like 500K to a million. I'm really bad at mental math, but
you're good. So
what's the check size and then the ownership percentage? I think
we target 12.5% ownership initial. I would say average check size is $1 million to $1.5 million. We reserve about 50% of the fund for follow-on, and the goal is to get 50% of capital into the top 4 performers. So when we think about that reserve profile, it's really trying to layer it into the best companies. Our goal is to own about 15% coming out of the Series A for the absolute best companies, but no less than 12.5%. So functionally like our pro rata on a go-forward basis.
Yeah, no, that's really helpful. And when do you think is a good point to start thinking about exercising that follow-on? Is it, you know, what's kind of the milestones that you look at? Is it more tied to like a funding round, or is it tied to certain traction or KPIs?
Yeah, so I mean, you know, but it's very case dependent, and it's also market dependent. So prior to 23, so 2020 to 2022, you almost didn't have enough time to pick up signals, right? Because rounds were happening so quickly that you had to make a decision based off the next funding round. We hated that because you don't actually have the data you need. And so we actually ended up shifting down allocation in certain companies because we just didn't know enough and we needed more information. In this market, you have a lot more time, right? And so a lot of what we do is level set expectations with portfolio companies and founders as to what we need to see. And that could be revenue, but it could also be technical development and integrations. It could be team progression. So there's a handful of things that a team can do to move the needle. And we set that on a per company basis. Again, the goal being for a lot of what we invest in, which are like technical, complicated businesses, it takes years to develop the initial asset to actually scale revenue and growth. So, but on the other side of that, these businesses should be wildly efficient. So oftentimes we view revenue to be a lagging indicator. And so we're looking at what the company is actually developing and how good the people are at moving the ball forward to develop those assets and relationships to inform the likelihood of success.
Sure. Yeah, it's really helpful. And then as far as portfolio LP updates, you recommend monthly, kind of like how, I mean, some founders do weekly updates, but as far as LPs, monthly or quarterly?
So we do quarterly. I would say I view companies to be different than funds in this instance. It's interesting. A lot of people are like, "Oh, you company should be sending updates." I actually don't agree with that. I think it can if it stylistically works for you. I think pre-product market fit, you should be sending updates because there's honestly not enough going on that you shouldn't have the time to send updates because you're really in like exploration, data collection mode, and you're testing. But like you should be able to distill that information. If you actually have demand post product market fit, you should have no time, right? There should be so much pull from your market that all you're doing is trying to keep up with that pull from the market. And you can send an update to your investors, which is, hey, we tripled, and they'll be really happy. So I think the concept of updates, I think, is relevant in as much as you aren't growing really well. Once you are growing really well, that is what matters to your investors. That's at least my view. As a GP for a fund, there aren't as many frequent tangible moments, right? So it's not like, oh my God, right now I never have to send out another update because we're going to kill it and we're good forever. So I think the reality is you want a cadence of whatever, monthly or quarterly, because really, in my mind, LPs view us like we are stewards of capital, which means that we are responsible on top of what we've invested in, and we should have the bandwidth to provide information to our LPs on a quarterly basis. So we send out quarterly reports. We do biannual calls with our LPs, and then we send out one-off updates on really relevant events. But we're interacting with our LPs no less than every quarter and often more.
Yeah. And talk about like community building and also just LP outreach. What has worked and what hasn't worked, and what are your peers telling you as well in terms of like just kind of their strategy to kind of just build that pipeline and then kind of get to the subscription document.
So I think first you need to establish like who you are as a firm, right? So the first large distinction is like, are you a marketing firm or are you an investment firm? Now they're not mutually exclusive, but if you think about YC, for example, like YC is the best marketing firm of all time within the venture ecosystem, which means that they have a ton of breadth, right? They see a ton, they get a ton of access, and like they will almost by necessity drive really good returns, but they're not focused on we need to make the best decision. They have frameworks for decision making. They're focused on we need to see every company, right? So first, are you a marketing firm? Are you an investment firm? If you are an investment firm, then it's really about that decision-making process, right? Which is like, how can we pick within the subset of information we see? How can we make sure we're picking the best company at the start and then supporting the best company on a go-forward basis? Once you have established kind of like who you are as a firm, I think that informs the audience that you go after, right? And so for us, putting ourselves in kind of like that investment firm bucket, we definitely focus on depth versus breadth, right? Which is to say that we're looking for super high value relationships, super long-term oriented relationships that understand and believe we are good at what we believe we are good at, right? Which is decision-making, in-depth analysis and reporting, and go-forward access to a subset of a category that we think has really strong growth on a go-forward basis. I think one of the mistakes a lot of folks make is trying to convince everybody that they should invest, right? Like we try to filter out as quickly as possible, which is, look, this is exactly who we are. Given who we are, is this something of interest to you? And it's completely fine if it's not of interest to you. I just don't want to have 5 conversations to figure that out. So once you feel good about your product, I think bring the product to the forefront, explain exactly who you are and why you're different, and filter out to high intent folks as quickly as possible. And then build your network there, which is, okay, like based off of who we are and what we are, how can we now build an audience that is aligned with what we think we can execute on?
Yeah, and I mean it's I mean the rule of thumb also is just have probably layers of messaging. So I'm
Hmm.
assuming, do you recommend like a one or two teaser decks and then kind of the full deck and then you go into diligence or something like that, or is it a screening call that you recommend to do first?
Yeah.
How do you, yeah, I guess for new fund managers, how would you layer the layers of information,
Yeah.
so you're not giving too much information if it's not a good fit?
Yeah. It's a good question. I'd almost like don't want to take like a broad brush because it's so bespoke, but I will say
Yeah.
like at least what we did is we put together a teaser deck, which was
Mhm.
a frame of references to again like why we are structurally different,
Yeah.
which we use as kind of like the entry points.
Hmm.
We also were able to leverage our network to offer that up to folks that are relevant, which is really just to get to know us as a firm.
Yeah.
And then after that, you just need to be very thoughtful about the triggers, right? Like
Hmm.
for a company, there's a natural reason to bring in capital at a certain time, right? For a fund, there's very rarely urgency. So the
Hmm.
goal is to figure out how to create urgency with investors. And I think that is making sure that your narrative is really tight in terms of how you're different and then
Hmm.
showing that you can execute towards that narrative. And so a lot of folks
Yeah.
will start to invest to show what the portfolio is going to look like.
Hmm.
Um, I think that's a completely fine strategy. I think tackle a fund size that you feel like you can create scarcity, right? So our first fund was $5 million, which meant that we needed 20 folks to write checks of 250K. Like that felt scarce enough, right? It felt like, okay, we can build enough urgency around that because
Yeah.
there's so much availability.
Hmm.
Next one was $25 million. And it meant, okay, we need 20-ish folks that can write $1 million checks. Again, enough scarcity within that. Part of the reason we haven't grown AUM that quickly is because one, like structurally, we didn't think we could deploy it that well and we wanted to do it methodically. But two, like we wanted to develop fund strategies that actually allowed us to go out, take that on and say, hey, we reasonably think we can hit this number with not
Yeah.
that many people. If you set a threshold too high, you find yourself in this limbo spot, which is like you're just
Hmm.
waiting on somebody to support you to catalyze that raise, and it's a really difficult spot to be in.
Yeah, one interesting strategy that I've seen, there was a fund that pretty much transparently in the LP email, like broke out the bite sizes,
Right.
and they provided scarcity by allowing smaller checks up front. But they said, look, we've got 100K check slots,
Right.
if you invest before this time. And it was super crystal clear how they broke it out.
Yeah.
So I think if you have some scarcity also tied to the check size, I think there's some great LPs that just won't do a certain check size, but they would still
Yep.
do those slots. And especially, and I've done that one time as well as like a smaller LP, because I knew that smaller check size to get in was soon to be gone. So
Yeah.
that was something that I learned too.
Yeah. It's basically just like, to your point, create bite-sized things,
Yeah.
right? Which is 100 million is a really large target, but okay, if there's a subset of only nonprofits for 25 million and only DEI investors for 50 million, right? Like you can create bifurcations through access or audience, and so just being thoughtful about that to try to create segmentation is a very helpful thing.
Mm-hmm. What about community events? Have you guys done like dinners or kind of small little summits? Because that's a big thing too. Some people, I've been fortunate to attend some really great AGMs, and I've kind of seen different variations of that. So, what are your thoughts around kind of engaging the LPs and intention, in terms of like the agenda that you should have? And for the audience, the AGM is usually like a yearly meeting. Sometimes they do it biannually, but it's kind of a great meeting to kind of a lot of times showcase portfolio companies. Sometimes, talk about exciting things ahead. So just any advice for people that are maybe planning their first AGM, what to do, what not to do.
Yeah. So one is, I think, again, this is an ethos thing. Like we've come up short in this bucket to an extent, which is like we've been so focused on investing well and building a good business, and so not focused on kind of like the marketing aspect of this.
Yep.
That we've ended up probably like delivering on fewer events and getting folks together less. But our goal has been to say, look, like you want us very focused on investing and building our business well. And so we hold that up when we speak to the LPs. So one, again, is kind of speak to like who you are and why you have that strategy. Now, as we've brought more people onto the team, we have started to invest more into this. So we created a scout program, like a traditional West Coast scout program. We now have scout happy hours every quarter, right? We now do one kind of like broad network event once a year, which we're actually doing in a week or so. But that type of thing where we can get the community together. I think my only suggestion is be very purposeful about what you are doing and why you're doing it, right? Like because we've done it more infrequently, the events carry more weight, right? Because it is not something that we're kind of just throwing out there, but it is intentional in terms of who we have there and why we're doing that thing. You could do it more frequently. I would just have purpose behind it. And I would think that holds for all communication. So your LP updates, the interim communications, your AGM, which we can talk about, but all of it should be very purpose specific because LPs have a ton of events, right? They're inundated with this type of stuff. It is far more important to be memorable once than to be kind of bothersome like 6 times a year. So know that they're not looking for more things to do per se. They're looking for things that drive value in some way. And so figure out again, kind of like what your value edge is.
Yeah. Know that all of these nuggets are really helpful, and I've been posting notes. This hour flew by, Brian. So thanks for being generous with your time, and let's definitely get some time to grab some coffee or do a drink in the future. We're both in the same hood, and wish you all the best. And again, excited to learn about all that you're doing, and appreciate all the wisdom that you shared.
Awesome. No, really appreciate you having me on. It was a lot of fun.
Yeah, thanks a lot, Brian. Take care. Have a good one.
All right, talk to you soon.
Yeah, bye.
Bye.